I'm going to share with you what I consider to be the 5 best monthly Canadian paying dividend ETFs. This is a way that I personally give myself a raise from every paycheck I get at my job. All of these have great long-term performance, have a history of increasing their dividends, and right now I personally believe are trading at discounted values. If you are somebody that loves passive income, consider hitting that like button, as we're going to first and foremost break down one of my favorites. And at the very top of my list is a stock called VDY, the ticker for the Vanguard FTSE Canadian High Dividend Yield ETF. This is one that I buy fairly regularly because it has the best performance and is currently trading up about 65% since its inception. Now, monthly paying dividend ETFs do come with a higher management fee because from an accounting standpoint, there's a lot more involved when you're having to pay out shareholders every single month. My breaking limit for management fees are around 0.3%. Once you look at things like mutual funds, they tend to trade anywhere from 0.5 to a 1% management fee on an annual basis, which is just far too high. So 0.2 to 0.3 is usually my breaking limit. But when you're talking about a 5.17% starting dividend yield, if you take away the annual fee, you're almost at an even 5%, meaning for every $10,000 you invest, you're going to be making about $500 annually or about $41 a month. I mean, if you put about $12,000 to $15,000 just in this ETF, you'll be getting over $50 a month, which would basically cover your phone bill in perpetuity for the rest of your life. That's how I like thinking about investing, because most people think you need millions of dollars to change your life, but 10, 20 grand could make a significant impact on one bill that you have to pay every month, and it just starts retiring your bills, and you can feel it impactfully in the moment. But taking a look at the actual rate of return, as we scroll down here, what I like looking at is since inception, which this goes back to about 2012, so just over a 10-year history, our rate of return has been about $23,000, and at the peak of the market was about 26, which means we've over doubled our money within a decade, which is usually my minimum kind of rates of return. I don't like buying things that don't at least double my money, because dividends shouldn't be the end all be all of your investing strategy, but these are great proponents to a diverse portfolio. Now, why does VDY outperform? Well, it comes from concentration, which also kind of brings on extra risk, because this one is highly focused in financials and energy. And if we take a look at those stocks specifically, Royal Bank and Toronto Dominion make up about 24%, 25% of this entire ETF. And you can see that, like Vanguard does, it weights the best market cap performers at the top and then kind of weights them down from there. So you got things like Canadian Natural Resources, Enbridge, which is an incredible company, Bank of Montreal, Bank of Nova Scotia. You got energy companies like Suncor in here. You've got your telecom giants like Bell. And I personally believe that many of these Canadian financial stocks are trading at discounts today. And this is one way of getting great exposure to that potential return in the future. And it's why I'm buying it so aggressively, considering the, basically the 10-year, dividend growth rate has actually been around 11.88%. Though we are in a tougher market environment, that's likely to slow down. But even still, like when you look at the dividend growth rate on this compared to many others, it's very, very nice. And if you take a look at it on a monthly basis, it is starting to level off a bit here as well. Bit of volatility because a lot of these, companies within this ETF pay quarterly, but it does kind of, average itself out. And we can see there's a lot of volatility in the past, but it has been trickling up and it has been tightening to the upside, where we're getting about anywhere from 15 to 18 cents on a monthly basis, which is very, very awesome. So second in line, we're going to talk about the iShares S&P TSX Composite High Dividend Yield Index ETF. That's a mouthful. For simple terms, the ticker is XEI, and this is probably like another fan favorite out there, because basically BlackRock does another incredible job. And if we take a look, fees are very low. We'll start with the hypothetical return here of 10,000 invested over a 10-year period. We can see that we would be getting, if I move my head out of the way here, about 17 to 18,000. At the peak, it was just about to hit 20,000, so not nearly the exact same performance as VDY. But if we go back to since inception from 2011, we're still doing very well with just over $20,000 in returns. They both kind of perform in a similar fashion. This one obviously is going to lack luster performance because it's a much more diverse ETF. If we scroll down and just take a look at some of the metrics here, the yield is a bit higher at 5.38%, and the management fee, if we scroll a little bit farther down, we're going to see sits right around 0.2, falling exactly in line with VDY. But because this is an equal weight ETF, a lot of the top holdings, again, are, as mentioned, equally weighted, with Enbridge, TELUS, TC Energy, Toronto Dominion, Canadian Natural Resources, Royal Bank, BCE. All of these are sitting at just around 5%. So the cool thing about VDY is, like the S&P 500, 500, a lot of Vanguard's S&P 500 ETFs like SPY or VOO, it's going to market cap weight the best performers because Royal Bank is the largest company in the world and it is a great dividend payer. It is at the top of the VDY ETF, whereas this one is more or less just equal weighting a lot of them. So you're not getting the same performance that you're going to get out of some of those other ones, but you're going to get less volatility. You're going to get a nice steady income that is a bit higher, maybe better for somebody in retirement. Taking a look at the Geiger here, also not as great. The 10-year sits at about 2.97%. And honestly, I think this just goes to the changing within the ETF itself because a lot of these do have good dividend growth. We can see on the 3-year, it's about 8.85%. Again, not nearly as good as VDY. And again, a little bit more consistent, I've noticed, but that probably comes in line with the equal weightings as well. Now, nonetheless, a lot of people do like to ask me about these, real estate investment trust ETFs. And as much as I like them, they have really underperformed real estate as a physical asset that you own over letting somebody manage it through a REIT. And it's something that I've mentioned with REITs, you're better off owning them on an individual level because REITs really are like a diversified ETF in and of themselves. You just have to pick the ones that have better performance and better management because as we look at the ticker VRE, the Vanguard FTSE Canadian Capped REIT Index, though these are great places to get monthly income, they're not qualified dividends. REITs are taxed as regular income, so they're not as tax efficient either. And the long-term performance, especially in market environments like this, proved to be absolutely abysmal. The management fees go well above what I personally like at 0.35%. Though it is monthly, the starting yield is only 4.23%, which again is rather low for most real estate investment trusts. And as we scroll down, honestly, what I would like to do is pick the better performers of the bunch because as mentioned, there's a lot of growth right now going on in the industrial sector. I do like REITs like Canadian Apartment Properties. There are a lot of good REITs within these different holdings. It's just on a really big scale of putting them all into an ETF. Even in the US side with a company like VNQ, which I'd prefer over, VRE. VNQ is a much better performer, but you can see against, a lot of the market volatility going back to 2008, you haven't really seen much of a capital return as much as you have a dividend. So at least VNQ yields over 5%, I do believe, and gives you a bit more diversity into the US markets. But honestly, if you're going to buy REITs, I would really recommend maybe picking 3 or 4 that have a good history of outperformance even during bad times and stick with that over the ETFs. But from a financial standpoint, I would rather do this in a diversified way with VDY or XCI. But for those of you that are looking for sector performance, or maybe you're in the US, there was a new ETF that came out. I've been mentioning this that somebody talked about on my live stream, which subscribe, I do weekly live streams, the Horizon Equal Weight Bank Index ETF, ticker HBNK. This one is fascinating because in a time where I believe banks are largely undervalued, they're paying wicked high yields. This ETF only came into inception this summer of July. And right now it's yielding well over 5%. If we take a look at just some of the facts that make it so intriguing to me is that the management fee up till July of 2024, so basically several months from now, they're not going to charge you any management fees to hold this ETF. And when the fees do come into play, it's only going to be 0.09%, which is the lowest basically within any sector focused ETF that I have personally seen from BMO or BlackRock or Vanguard. So this is very, very intriguing to me and could be a great way to get a discounted value across the broader bank index without me having to buy them on an individual level. Because if we scroll down and take a look at the holdings, equal weighted between all the majors: Toronto, Dominion, Royal Bank, National Bank, Canadian Imperial, Bank of Nova Scotia, and Bank of Montreal. So this could be a great way to just immediately diversify between one of the greatest sectors in the Canadian economy. And it's one that I've had on my radar now for a little while, and I may even consider buying it into my tax-free savings account. Now, finally, the last thing I want to explain to you are these high interest savings account ETFs, which I've mentioned in the past, and I don't believe them to be traditional ETFs because you do not get compounded dividend growth over long periods of time. I would not make these huge percentages of my portfolio, but if you're looking for stability, if you have an emergency fund and you're looking for a place to park it and make a higher rate of return in a very secure investment, you can look no farther than these kind of ETFs like the cash ETF from Horizons, which is currently yielding 5.36%. The way these ETFs work is, I'm sure you've heard from your bank. You probably got notices in the mail saying, hey, we have a promotion. We'll give you a 5% interest rate for the next 3 months if you open an account with us, and blah, blah, blah. So instead of you putting all the effort and time into it, that is what these ETF managers do, and they take a surprisingly small fee to do so. So if we take a look first and foremost at the holdings, you're going to see that basically it's just split up between whatever banks have the best promotions, like National Bank, CIBC, and Scotiabank. And right now, National probably having one of the highest, rated promotions. You can see they put most of the money within that bank. Very stable, very well performing, and they usually charge about 0.15. This one's charging about a 0.11% management fee, or basically a 0.10%, which is lower than some of the other ETFs we looked at, and it does pay monthly. Another one that I look at is called the Purpose High Interest Savings ETF, and you can see that basically as the interest builds out, it pays it out monthly, and the only volatility in this ETF is them paying the dividends out. It's basically very stable at around $50 to get into it. And as interest continues to go up, your monthly payments will go up with it. But in the vice versa, if interest rates start to come down, guess what? These monthly payments are going to come down with it. These are more or less a short-term Parker place for cash than perhaps a long-term considerable investment, but they are much more liquid than GICs and bonds, and they pay just pretty much the same. The Purpose High Interest Savings is another one that pretty much holds the exact same, banks with a 0.15% management point or 5.4% yield. And again, if you break down the portfolio, you're just going to see all the same banks, whatever one's paying the best promotions. So these are what I consider to be the best monthly paying Canadian dividend ETFs. I know a lot of people would like to throw in some option ETFs. They get a little more convoluted, come with more volatility, and tend to lack luster over very long periods of time in the performance. So I just wanted to give you what I would put my own money into, not as financial advice, just after 8 years of investing, what I've kind of stumbled into that I like the most. And I'd love to know what you think about that in the comment section below.